Let me tell you a little bit about Rob Carrick. Rob's been writing about personal finance, business, and economics for close to 25 years. He joined the Globe and Mail in late '96 as an investment reporter, and he's been writing the column on personal finance since 1998. He's the author of several books, including his most recent one, which, by the way, Rob, I want to get an autographed copy of this, called How Not to Move Back In With Your Parents. So far, my daughter is doing really well, but I want to make sure. Rob lives in Ottawa with his wife, Teresa Humphreys, has 2 sons in university, so he needs to be smart about investing. Rob, let me turn it over to you.
Thank you very much. The title of my talk is What Retirees Need to Know. Now, how do I know what retirees need to know? Because I talk to retirees every day. I get emails from them all the time. They're my most engaged, loyal readership group, and I'm happy to answer their questions on a daily basis through email. And if you guys want to email me at rcarrick@globemail.com, I'll answer your questions too. But doing so gives me a pretty good insight into what's on the minds of retirees, and I've tried to distill that into today's presentation. The financial and economic challenges, this is sort of, I put these bullet points up and I'll discuss them in more detail, but the idea is just to sort of give you an idea where we're going to go in this. We're going to talk about some of the investing challenges you face, but also the big picture things that are guiding your investment results and are weighing on the economy. First one is what I call the stock market roller coaster. I'm going to tell you a little interesting factoid that I read about yesterday. Millennials, young people roughly between the ages of 20 and 30, have looked at that chart there. They've absorbed what the stock market's done in the past 8-9 years, and half of them now decide that the stock market is not worth their time. The risks are too big, and they're not interested in using the stock market to build wealth. I think that's a mistake, and I'll be working hard to change their minds. But I thought that's an interesting perspective on how volatile the stock markets have been. As having a long-term perspective on investing, as I'm sure you all do, you remember the 90s when 10-15% returns were the norm. We had a great run right up until 2007. The market tanked in 08-09, lost about half its value at its worst point. But it's come up pretty nicely, and then all of a sudden we've run into a pretty bad year, and you can see that we've lost a lot of our gains. This is the new reality for stocks. I don't see us anytime going back to a decade of average double-digit gains. We'll talk more about expected returns in a little while, but this is the new reality for the stock market. It's going to be nasty, and you have to accept that if you're going to be in it. It's not to say you're going to lose money in it. You just have to keep a long-term perspective and keep understanding that you have to absorb the downsides to capture the upside. Bond yields, bad news here. If you think bond yields are low now and you're looking forward to a rebound at some point, it's going to take a long time. I've been looking for higher yields, higher interest rates since 2009, and I've been wrong every year. And I've stopped forecasting that. And the reason is that I've been convinced by the analysis that I've read that we're no longer going to return to the normal world we were in before the financial crisis in 08-09. High growth, significant inflation, interest rates, in the 3, 4, 5%, 5-year mortgages in the 4 or 5% range. We may get back there. I don't know if any of us will see it in the near future, though. There's a couple of factors going on that are going to keep bond yields depressed. The global economy is in terrible shape. It's just not rebounding. Look at Canada. We have struggled since 08-09. We had a very brief recession, but we have not hit our stride. Economic growth this year is projected to be 1%. The inflation rate's basically 1%. We're almost not growing at all. Next year, the Bank of Canada is projecting 2%. They've just downgraded that from a previous more optimistic more optimistic forecasts. Low oil prices are weighing heavily on our economy, and there's really not much optimism that they're going to rebound anytime soon. If we've got low economic growth and we've got low interest rates, that's a package that's going to keep you struggling to find yield. And I might add, there's one other interesting new perspective on why rates are going to stay low, and that is our aging demographic. There's a new theory that as the population ages, there'll be more of a larger group of people who are not working, and a smaller group of people who are working. That will ramp down the amount of economic productivity in the country, and that will put less upward pressure on inflation, and that means interest rates won't have to rise as much as they might have in a previous time. So when rates do go up, don't look for dramatic increases. The 5% GIC for 5 years, I don't know if we'll see it again in our lifetimes. High house prices. I think this is one of the fundamental stories in our economy right now, and every demographic excuse me, has a different perspective on it. But I think your perspective is particularly interesting because you've got an asset to manage, your house. If you've owned a house for 10, 20, 30 years, you've done extremely well in Ottawa, and not as much so as in Toronto or Vancouver. But houses have appreciated significantly. My wife and I have owned a house in the east end of Ottawa for about 15 years, and it's more or less doubled in value. Other neighborhoods might have done better than that. You've got an asset to manage, and we live with a narrative on real estate that it always goes up in price. And partly that's an influence of how much the national media focuses on the Toronto and Vancouver markets because they're so dramatic. Here in Ottawa, we never saw prices go up quite as much. It hasn't been the crazy hot market, but we have enjoyed a lot of real estate appreciation, and it's been a great run for housing. The blue line on that chart, that's the U.S. market, and that reminds us what happens when assets rise in price. They pull back. It's very natural. It's called the cyclicality of investing, of real estate markets. Our market hasn't retrenched. Now, if you think that line, that red line, is just going to keep rising and rising forever, I would have to strenuously disagree with you. I'm not predicting a crash. I am not a forecaster of real estate prices, but I am a long-time observer of financial markets, and assets just do not keep rising forever. There's two ways that they may come back down to earth. There could be a severe correction. I'm kind of skeptical that's going to happen. I just don't see the risks out there of that. Or there could be a mild pullback in prices or a long period of sideways stagnation. So what does that mean to you? I think it means you want to be strategic about your house. If you are a person who wants to live in your house indefinitely, you want them to carry you out of your house in a box, and I've heard that many times, then fine. Then just recognize that the value may fluctuate between now and the end. If you have equity in your house that you'd like to extract, to cover retirement expenses, to leave as a legacy, to help your own kids buy a house, then you have to think, what is the opportune time to make my downsizing move? I think now's not a bad time. Yes, you may well sacrifice some upside, but you are eliminating the risk of a price pullback. You're eliminating the risk of a poor, weak market where you can't sell. Your house is on the market for 6 months, a year. I would encourage you to think about what's my exit point? I'm not telling you it's now, I'm just saying think about when works for you. Household debt, another big story in our economy. Do you know what the demographic that is growing its household debt the quickest is? Seniors. Dramatically and by far and away faster than other groups. Now, it's a very small base, it's much smaller than the other groups, but the percentage growth rate is significant. So what that tells me is that a lot of seniors are not able to make it. They're not able to live within their means. They didn't save enough. They probably don't have how defined benefit plans like you do, and they're not making it. So the debt issue is quite important beyond the seniors who are increasing their debt levels, and the reason is it's very bad for our economy. It's a big risk for our economy. And so it wraps in with housing. If interest rates rise and people have trouble paying their bills, they're going to stop spending on other things, and that's going to be a big hit to our economy. So keep this in mind. When you read statistics in the newspaper about how high debt is and how debt keeps growing, it's not distance from you, even if you don't have any significant debt. This is one of the biggest economic risks out there. And what we really need is for Canadians to stop increasing the amount of debt they're taking on. If we could get growth in debt in line with inflation and in line with salary increases, we'd be on a much more stable plane. But we're growing debt at a faster rate. And again, you can see what happened. The red line is the United States. They had a big recession, and the bottom fell out of their debt growing. If that happens in Canada, that's going to weigh heavily on our already slow economy. Let's talk about investment returns. A lot of people were not satisfied according to the poll, and I'm a little worried because I don't have any good news for you. What I do have is some realistic numbers that you can use to judge how you're doing, to put some context on it, because too often I think we look at our returns and we don't think, how does that rate given the times, given the conditions out there? We look and we judge them by historical standards. For instance, a lot of us may think that 10% is a good rate of return for a portfolio or for the stock markets year by year. That's old thinking. I don't think that applies in the years ahead. So what I did, so I consulted 11 experts, money managers, investment strategists at big companies, just run-of-the-mill, everyday, working with clients, investment advisors, and I asked them, what is your projected return for the next 10, 20 years for a basic portfolio of 60% stocks and 40% in bonds? And I'll discuss in a minute whether that's an appropriate model for you. I don't think it is, but it's an appropriate model for the mass population, certainly. And so what they came up with is a high portfolio rate of return rate of 8%. That was the optimist in the group. The pessimist was saying 2 to 3%, and we ended up with an average of 5 to 6%. And my caveat to you is that this is before taxes and fees. So I'll talk a little bit more about fees, but in a low return environment, and this is a theme I hear over and over again, the low return environment, the investment industry people are reining in their expectations. They're usually the cockeyed optimists out there telling what they're going to do for you. They're going to get you 10%. Anyone who's telling you that right now is dreaming. I don't know what kind of risks they're going to take on to try and get that for you. 5 to 6% is probably a good benchmark for you to use before fees. Now, how much are fees? They can range from less than half a percentage point if you have a low-cost, do-it-yourself portfolio with exchange-traded funds, or it could be 2% if you've got an investment advisor who's managing your portfolio for you, and I hope giving you lots of extra value in terms of financial planning. So we could be talking about net returns before taxes of 3 to 4%. So keep that in mind when you are looking at your returns, and maybe you're not that happy with them. That's fine, but just understand that you may not be losing out. Your returns may be very much in sync with the world that we live in right now. How to invest in a low return world. I'm going to give you some random thoughts here. First one is index investing. Can I get a quick show of hands if you're familiar with or actually practice index investing? Okay, great. That's a very, very high and encouraging percentage. For the ones who don't and maybe aren't familiar with it, basically you are buying investment vehicles that track major stock and bond indexes. And the beauty of index investing is that these products that track the indexes are very, very cheap to own. They cost next to nothing to own. A mutual fund might cost you 2%. An exchange-traded fund that tracks an index might cost you 0.06%. I almost round that down to free. There are some more expensive ETFs out there, but even there you should be able to build a very nice portfolio, very well diversified, for about half a percentage point in fees. There are index mutual funds out there. They're sold by the banks. I'm not that crazy about them because they are more expensive to own. An ETF is an excellent portfolio building block. It's good for young people. It's good for seniors. There are ETFs that ETF is the short form for exchange traded fund. There are ETFs that are tuned towards paying monthly investment income, and you can decide what kind of income you want. Do I mostly want dividend income? There are ETFs for that. Do I want a mix of bonds and preferred shares and dividend-paying common shares? There's ETFs for that, high-yield bonds. Quite a lot of choice. So I encourage you to think about that as a way of restraining your fees and helping to increase your returns. Because one of the most basic rules of investing is that less you pay in fees, the more you keep for yourself. Dividend growth stocks. I'm sure a lot of you are keenly interested in them. The retiree seniors demographic among the global readership is voracious about content on dividend stocks. I write a lot about it myself. In fact, I'm doing a column this Saturday on dividend growth. And unfortunately, it's talking about how dividend growth isn't quite as robust as it used to be, but it is still a great tool for the income-seeking retiree. Dividend growth means companies that increase their quarterly cash payouts to their shareholders probably once a year on average. And the beauty of that is that by and large, the increases tend to be well above the inflation rate. So what you're doing is you're giving yourself inflation protection on your income flow. And this is a way of building your returns in this lower return world. For instance, Royal Bank and TD Bank have been increasing their dividends over the last 5 years by about 10% a year. Now, what bond or GIC do you own that's doing that? There's many other stocks that have been increasing about in the 5 to 10% range. They're all across various sectors. Check out my Saturday column and you'll see a list of stocks that have very good dividend growth records over the long term. Another option is the more aggressive asset allocation. Asset allocation is just a fancy term for the mix you have of stocks and bonds and cash. I'm just going to backtrack a bit and talk about the case for buying the index. The thing about index investing is that you get what the index gives you minus a little fee. Mutual funds give you the return of the portfolio designed by the investment manager minus quite a bit of a bigger fee. So what happens after you take the fees out? You're left with an average mutual fund return. Now, over the 1 and the 5 year returns, mutual funds are actually beating the index. But I don't really put that much importance on the 1 year and 5 year returns. Those are fairly short term. If you're investing in the stock market, you've got to keep a longer term focus, 10 years at least, 20 years ideally. And here you can see how the indexing approach starts to pull well ahead of the mutual fund approach. Lower fees enable the index to give you more, and so you've got returns and the gap spreads as the longer time goes. I've been comparing index investing with actively managed mutual funds for a long time, and in most cases, over most time frames, you've got the 1, 5, 10, and 20-year cases where the average fund does not match up to the index. So what's different today? The index has a lot of oil and gas in it. And a lot of the mutual fund managers are just easing back on oil and gas, and that's helping their short-term returns look good. Another factor is, have you read about Valiant Pharmaceuticals in the news lately? Well, Valiant, for a brief time, was the largest stock in the Canadian stock index, and it's tanked lately, and it's weighing down index returns. But even with all those headwinds for indexing, the long-term numbers still show you the benefit of buying investments that track the index versus regular mutual funds. Now, getting back to asset allocation, you are a very particular group for asset allocation. What applies to most people does not apply to you. So let me put that in some context. Rule 1, 100 minus your age is the percentage in stocks that you should go with. That's the tried and true method, the one size fits all. It's a bit out of date though. It doesn't reflect the fact that people are living longer lives and are going to need to build their assets even after they retire. There was a thought that when people didn't live as long and they hit retirement, it was all about preserving what they had saved and invested and built over their working years. Now, with people possibly spending 30, 35 years in retirement, you've got to keep building your retirement assets, and that's why there's a new rule, Rule 2, 110 minus your age. You can see how that will give you extra extra weighting in stocks. And then there's rule 3 at 120 minus your age. We're squeezing down the bond side of your portfolio even more there. And that's sort of an extreme view for the mass population on how much they should have in stocks and how much in bonds. Now, it's different for you because you have a defined benefit pension plan. In a way, that's a bond. So you have to think about what percentage of my total investable assets is my pension, and what percentage is my the investments I've accumulated on my own. And if your pension is a major piece of your total financial assets, well, you may already be in rule 1, 2, or 3 position without putting a dime of your own personal investments in bonds. Now, I don't like to oversell the security of defined benefit pension plans to people. In certain sectors, they're iffy. The company providing the plan may not be built for the long term. The plan may be underfunded. That presents future risks if the company can't get the pension fund properly funded. Moreover, I've been reading stories about DB pension plans that are not able to deliver for their members, and they have to dial back the assets. I should say dial back the benefits. In the States, if you want to read something scary, Google up the state of Illinois and its pension problems. It's very, very severe. There's a lot of question about whether people are going to get the benefits they expected. Now, I'm not so worried about your defined benefit plan because it's backed by the federal government and is well funded and is in good shape. So, you have a defined benefit plan and you can have a high level of confidence in your plan that puts you in a great position to think about investing more aggressively if you choose to, if you're comfortable with that. If you're okay with that stock market chart I showed you at the very beginning, then you can go ahead knowing I have this very strong base for my DB pension plan that pays me income. Now, on the other hand, though, if you're fine with your pension benefits and you are risk averse, your pension is giving you permission not to invest aggressively. If you don't like the stock market and you think, I would rather opt out, you're under no pressure to build up your personal assets in order to generate retirement income for yourself. A lot of people who have not saved properly for retirement have decided that investing aggressively is the way to get themselves out of their problems. I will try for an 8% return instead of a 6% return, but the problem is that as you strive for higher returns, you introduce more risk into your portfolio. So you have to decide where you stand as an investor and then pick your strategy. If you're aggressive, your pension plan gives you a great foundation to do that. And if you're cautious, then your pension plan is giving you permission not to invest super aggressively. Now, we talked about big picture stocks and bonds. Another key aspect of asset allocation is geography. You don't want to have all your assets in Canada. And the last few years have made this point better than I could. Global stock markets and the United States have kicked our butts. Our stock market is about 1/3 tied to commodities, to metals and to oil, and prices for those commodities have been very, very weak lately, and that has depressed our stock market. The U.S. market has trounced us, and the international markets, which are outside of North America, have trounced us as well. So I put this up here to give you an indication of how you might divide up your portfolio. So what I've done is this would basically be of the portion of your portfolio in stocks, this is how you might divide it up. It's just an idea. Half of your stock market exposure would go in Canada, 1/4 in the United States, and 1/4 international. Again, that's everywhere but North America. But just to give you some perspective on that, what I've done is I've put the percentage that each of those 3 choices represents in the global stock market. Canada is 3.5% of the global market. We are statistically insignificant. The United States is basically the whole market, and the international markets are the remainder. Now, back in the 1990s, the Canadian market was underperforming global markets, and I heard a lot of investment people say, well, I'm actually going to suggest people squeeze their Canadian content down to 3.5%. and have almost all their investments internationally and globally in the United States. And that would have been a great strategy looking backwards from that point. But looking ahead, what happened is commodities took off, the Canadian dollar took off, and the Canadian market absolutely annihilated the global market. So I don't think you want to make a bet like going down to 3.5% on your Canadian content. We live in Canada. We understand Canada, and we can have a big piece of our portfolios in Canada. This is one more point on asset allocation, and it's a point that was driven home to me in 2008-09 when the markets crashed and the federal government had to tell people that they could, to give them special latitude on making their annual mandatory RIF withdrawals. And the reason the government felt it had to do this is a lot of seniors were saying, I will be forced to cash in my hard-hit stock market investments to make my annual RIF withdrawal, and I don't want to be forced to do that. The fact is that they should never have been in that position in the first place. Keep enough cash or liquid investments in your account to cover 3 years worth of living expenses. If you think that's excessive, go down to 2, but don't go less than 2. That can be sitting in high interest investment accounts paying about 1% right now. It could be in treasury bills. It could be in cashable GICs. It could be in ladder GICs. I make my annual RIF withdrawal on June 30th. I will have a 1-year GIC that matures on that date and a 2-year GIC that matures on that date. Do not put yourself in a position of having to cash in your stocks or your equity funds or your equity exchange traded funds to meet your RIF withdrawal. Keep that money in cash. It's a great stress reliever. The markets can tank and you think, okay, I have my cash cushion. One more hit on asset allocation. I don't think you need to be fancy. There are investment people out there who build portfolios with all kinds of extra components. Precious metals, gold, commodities. That means usually exposure to commodities futures contracts where you're betting on future price declines or increases. Alternative strategies, that means hedge fund techniques like selling stock short. And finally, inverse ETFs. Those are ETFs that make you money when the stock market declines and you lose money when the stock market increases. Don't get fancy. You don't need to get fancy. You know what? You're going to get yourself into areas of complexity where you don't fully understand the downsides, and the downsides are not widely published. People want to sell you investments. They don't want to scare you into not buying them. If you don't understand something or you just feel like you don't have a high level of comfort, avoid. Keep it simple. What you really need to consider as candidates for your portfolios are some kind of bonds. There's a wide variety of bonds, but I'll leave it to you to fill those in. You need coverage of stocks, the various global stock markets, and that's pretty much it. Well, people will say, oh, but I need real estate. Well, there are a lot of real estate investment trusts in the Canadian market. You're covered on that. Some people will say, well, you need coverage of resource stocks. Well, the Canadian market is about 1/4 to 1/3 resource stocks, so you've got that covered. Keep it simple. It's a very good investing rule. Global investing pitfalls. So the portfolio mix I showed you a minute ago had half of your stock market exposure outside of Canada. There are risks to doing that. Number one is currency risk. If the Canadian dollar takes off, it's going to kill your returns in US dollars. Also, if you're investing outside of RRSPs and RIFs, you've got to pay attention to how your dividends are treated. In an RRSP, we have a tax treaty with the United States, and they don't tax dividends paid into your RRSP or your RIF account. But we don't have that kind of a treaty on TFSA, so there will be some withholding tax taken off the dividends paid into your TFSA, and you can't recover those. In a cash account, you can claim credit for paying those U.S. dividends on your tax return and net it out that way. But the fact of the matter is that we're all very keen on dividends. If you're buying U.S. dividend stocks, and why shouldn't you? There are some great companies. RSPs and RIFs are really a great place to do that kind of investing. There's political risk as well. You know, we invest in a country like, let's say Russia, and there's some political trouble. All of a sudden that can affect the value of our investments. And finally, there's the whole commodity issue, which I explained earlier. That is that we are big on commodities in the Canadian market, and if commodity prices, when commodity prices rebound, Canada will be the place to be. Now, I just want to go back to the currency risk at the top there. The way you work around that is to consider buying mutual funds or exchange-traded funds that use currency hedging. They just call it hedged. It'll be the hedged S&P 500 fund, for example. And that means you're going to make the return of the S&P and you don't have to worry about what the dollar's doing. Those kind of funds do well when the dollar's rising, and they do poorly when the dollar's sinking. The dollar's sinking now, so you don't want to be in a hedge fund. So what I suggest people do is consider having half your global investments in hedged and half in unhedged. That way some of your money will be doing well when the dollar's rising, and some will be doing well when the dollar's sinking. How many here are do-it-yourself investors? Okay, good, a good number. I think there's a lot of misunderstanding about what do-it-yourself investing is all about and what financial advice is all about. Some people think I'm investing for myself and I'm saving myself 2% that my friend pays an advisor. It may not be a fair comparison. You are managing your investments, and that's fine. Your friend who pays the 2% may, stress on the may, be getting investment management and financial planning. So if you're a DIY investor, consider the financial planning side of things. If you need help planning cash flow, with estate planning, with tax planning, that's something you're not getting in your DIY world. You may want to consider finding an advisor who can help you with that sort of thing. The people who have advisors, I hope you're getting that sort of advice. Financial planning. If you're not, go to your advisor and say, I want a financial plan. What do we do? Where do we go next? And they should be able to help you with that. When we're assessing investment costs, please pay attention to value and not the bottom line cost. The bottom line cost isn't really helpful until we consider what we're getting. I'm a DIY investor and I'm running things super cheap. I compare it to the advice option. What am I getting for the advice? If I'm getting only a portfolio of mutual funds to buy and I never hear from my advisor, I am not getting good value for my fees, and the DIY option seems excellent. If I'm getting a lot of financial help, maybe the advisor is helping my kids, I'm getting help with taxes and estate planning, you can't compare that to the DIY investor because they're not getting all that advice. We have a fee tool. I don't know whether you have pens. Write down that URL there. Plug in the investment fees you're paying, and we'll tell you how you compare to other people. Very useful tool. It's very hard to do that without, unless you use a tool like that.
Can you read that URL?
I definitely can. It's tgam.ca/fee tool. And if you find that you didn't copy it down right when you get home, just Google Rob Carrick's Globe and Mail fee tool, and you'll get right to it. And in closing, and I'm happy to take your questions for a few minutes, I want to just go over a couple of other themes that should be top of mind as you're thinking about your investments. Longer lifespans, huge issue that we really haven't got around to thinking much about. Big implications on preserving money. There's been this idea percolating for about 20 years of this great, huge wealth transfer that today's seniors were going to be passing along to their kids. And what everybody forgot to factor in was the fact that the parents are going to be living to 90, 95, and 100, and they're going to need that money to live a comfortable, happy lifestyle. There's not going to be that much left. I say to you all, spend it and enjoy it. That wealth transfer was just basically a pipe dream of the financial industry. They thought they would generate tons of fees churning this money from one person to the other. It won't happen. Aging in place. This is a theme I think you should all think about. What are the costs for me to age in my home instead of going into an assisted living center? Investigate the fees if that's something you'd like to be so that you're financially prepared for it. Long-term care costs. Sometimes events happen where we need help and we have to go into a long-term care facility. Just check out the cost of that, $3,000, $4,000, $5,000 a month. how are your finances situated, that if you needed that, where would the money come from? And finally, helping your kids and grandkids. A lot of people who have paid off their houses and are in retirement and find themselves with some extra money, their legacy. You can put it into your will, but a lot of them are deciding to pass the money along now while they can see their kids enjoy it. They can help their kids buy houses. They can help their grandkids with university. Just something to think about in your financial planning. Anyway, that's pretty much what I had to say, and I would be glad to answer a few questions.
Microphone there, please.
I have a question.
Let's grab the microphone.
I think I can do it well. Can everybody hear me?
No.
Okay. Up to you. Index versus other mutual funds. I've understood what you've said about index funds. They generally work really, really well over the long term because index funds represent the market. I've been told recently that in this particular market, basically going sideways, index funds are not the way to go, and that you need mutual funds or similar that are highly active trading. Your thoughts?
I don't agree. I think that is something that the mutual fund industry likes to say to sell mutual funds. I think the long-term results I showed you there show that although those actively traded funds that trade a lot, and first, frankly, trading a lot is a lot of guesswork, and it generates a lot of money lost in stock trading commissions. I think you might get lucky in a very short period of time and outperform, but I go for what works over the long term, and I put my faith in index investing. But let me just add, there are some very good mutual funds out there. It's just that they are a minority, and the majority are underperforming and overexpensive. If you've got a good low-cost mutual fund that's working for you, enjoy it, and don't feel you have to get rid of it. I'm just talking about, for the most people, indexing investing is a very, very good option.
Back there to the back microphone.
Hi, my name is Michael Korber. Thank you very much for your presentation. One thing that might be of interest to more than just myself is the idea of getting some U.S. Dividends or income to spend when we head south at various times of the year, as many of us probably do. You didn't mention anything about U.S. dividends or income. Can you talk a little bit about how we could generate enough to pay for our ill-gotten vacations in the south?
Well, what you could do is you could set up a U.S. dollar investment account at an online brokerage firm, and you could buy U.S. listed investments, be paid U.S. dollar dividends, and withdraw those U.S. dollars from your account. Just remember that you, if it's in a non-registered account, there will be some tax issues with the dividends. It's not prohibitive or anything like that. It's just a little extra bookkeeping. But by all means, the U.S. has outperformed Canada handily. It's got all kinds of things we don't have. It's got a great tech sector and a great healthcare sector. Canada has next to nothing in those areas.
Back microphone again.
Just a quick comment to add on to what you just said about investing and taking money out in the U.S. I use my TFSA and I split it into U.S. and Canadian. It takes a bit of paperwork, but then you can extract that if you have U.S. funds. So that's one thing. First of all, Rob, I would like to thank you for adding a new element to my exercise regime, because as of October 16th, I now have to walk to my local library to read your column in the Globe and Mail.
Well, I appreciate you making that walk.
It's worked. I mean, I was 20 pounds heavier on this. My question is, how could you give us some advice on the best tax software we could find to calculate the best pension splitting combination for us?
You know what? Intuit TurboTax is probably the gold standard, but it's also the most expensive. What I would suggest you do is see if any of the free software packages will work for you, and if they won't, then you could investigate TurboTax. And if you just do a Google search for Canada Revenue Agency approved tax software, there's a nice directory online, and it even includes the ones that are perfectly free. And even with TurboTax, if I'm not mistaken, you can use the online version and play around with it, and you only pay when you file your taxes. So those are some options for you right there.
Lady right here.
Yeah, my name is my name is Fatma Magid. I'm not one of those who have any investments. I had a single parent who had to raise 4 daughters, so I didn't have any place to. But I have a decent pension, the superannuation pension from the government. But my question is, there was a threat that our pension will be targeted by if we had another conservative government. So my question, I'm 68. My parents lived into their late 80s, early 90s. So there is another 25 years of pension. If I am going to be risking, I see the risk that a government can come and decide to target our pension. It's not given anymore that we are. So what would your advice be to me for the pension that I have now to invest to be able to?
Well, what I would suggest you do is you use a tax-free savings account to build up your own investments as much as you can. For instance, if your pension payments and your CPP and OAS and everything else leaves you with a surplus of money, you could invest it in a tax-free savings account. The limit's going down to $5,500 from $10,000, but it still leaves you plenty of room to invest this money. You can build yourself a nice diversified investment for you. It's all yours. If it's in a tax-free savings account, you won't pay any tax, and I think that would give you assets that you yourself control and no one can take away from you.
Going to do 2 more questions.
Sure.
Gentleman back there.
Okay, my turn. I appreciated your slide on the house value. So I have a house, I'd like to get my money out.
Right on.
Any advice on how to do it?
Well, do you want to move out of the house, or do you want to get the money out while staying in it?
Either way, I just want my money out. I'm happy to
Okay.
sell it, I just want my money out.
That's one of the problems with a house. It's hard to go ka-ching and it spits out the value. You know what? The best way to do it is to downsize. Sell the house, find your next place, make it a cheaper place, and pocket the difference. If you rent instead of buying, then you've got all your capital taken out of the house and you decide what you'll do with it. You can invest it, you can take a piece and live on it, you can add it to your retirement savings. If you want to stay in the house, there's reverse mortgages. Don't like them unless it's like a short, very short bridge period. You can borrow and against your house value with a home equity line of credit. Again, you're going to be paying a lot of interest every month on that. I think for you, from what it sounds to me, without looking in depth at your finances, you are a person who should look at selling and finding your next place.
Thank you very much.
Two more questions. Lady here in yellow. You pass the microphone down.
Thanks for a great talk.
You're welcome.
What do you think of segregated funds?
Segregated funds are mutual funds that have an insurance aspect to them. After 10 years, you're guaranteed not to lose money. I think they're quite useful because they have interesting estate planning characteristics. You can basically put money in them, and it doesn't have to go through probate when you pass away. Also, if you're a business owner, you can invest in seg funds, and if your creditors cannot access the money. But I'm not really impressed with them as a safe way to invest. I don't think you need a guarantee that you're going to make money after 10 years in the stock market, because the stock market almost always goes up over 10 years. The risk of losing money is just infinitesimal, and the fees for seg funds are a little higher. So if you want them for the estate planning aspect, I think they're very interesting, but I don't think they have much to offer as a safe investment.
We're going to do one more question, the gentleman in the second microphone.
Okay.
And then after that, if you want to talk to Rob privately, you'll...
Yeah, I'm going to stick around for the coffee break, so I'm happy to talk to
in
you.
trouble if I don't cut this off.
All right.
So, gentleman back.
About index funds. If every investor starts tracking index fund, then back to square one. Any comment on that?
Yeah, you know what, I think there's no risk of that. I mean, theoretically, if everybody was an index investor, then, that wouldn't be, it would basically, the rushing into index funds would somehow upset the market, and it would not be as great a way to invest. There's no risk of that. There's about $60 billion in exchange-traded funds tracking indexes, $1 trillion in mutual funds. Okay, so
3.5% of the...
yeah, exactly. So there's your index tracking, and there's your mutual funds, where everybody's where the managers are picking their own stocks. It's just, it won't be a risk in our lifetime and probably not our kids' lifetime.
Thank you very much, Rob. Much appreciated.
Thank you.